Hello, and welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today is October 13th, 2025, and we are breaking down the S&P 500 ETF, ticker symbol SPY. The market is on edge after a dramatic end to last week, and we're here to unpack the news and the charts to see what might be next. First, let's cover the current events that are shaking the market to its core. The biggest headline is former President Trump's threat on Friday, October 10th, to impose a massive increase in tariffs on China. This was in response to alleged Chinese restrictions on rare earth metals, with Trump accusing China of becoming very hostile. The market's reaction was swift and brutal. The S&P 500 experienced its worst single-day performance since April, dropping a staggering 2.84%. This sharp move sent the Fear and Greed Index squarely into the fear zone, a stark reversal from the optimism we saw just days earlier. It's a classic example of how quickly geopolitical news can override underlying market fundamentals. This sell-off came just after the S&P 500 and Nasdaq were hitting new all-time highs, fueled by a powerful rally in the tech sector. Companies like Nvidia and AMD were surging on positive AI news, and Dell announced significantly upgraded financial targets, painting a very bullish picture for technology. Adding to that bullish sentiment, minutes from the September Federal Reserve meeting indicated a strong likelihood of further rate cuts. In fact, futures markets are currently pricing in a 93% chance of another quarter-point cut at the meeting later this month. However, as we saw on Friday, one geopolitical headline was enough to erase weeks of gains and put that bullish narrative in jeopardy. Interestingly, Reuters reported that U.S. stock futures rose this morning, suggesting some investors are buying the dip on hopes that Trump's tone might soften. This highlights the extreme sensitivity of the market right now, where every headline can cause a significant swing. Now, let's transition to the daily chart for SPY to see how this news has impacted the price structure. As you can see, the long-term trend since mid-2024 has been clearly bullish, with a series of higher highs and higher lows. Just last week, we printed a new all-time high around the $674 mark. But this candle from Friday, October 10th, is a major cause for concern for the bulls. It's a massive bearish engulfing candle that closed near its low at 653 on extremely high volume. This indicates strong selling pressure and has decisively broken the recent upward momentum. This breakdown establishes the old high of 674 as a powerful new resistance level. For the uptrend to resume, buyers would need to reclaim that level with conviction. On the downside, the immediate support is Friday's low, right around 652. If that level fails to hold this week, the next major support zone comes into play between 640 and 645, which corresponds to the consolidation area we saw back in late August and early September. A break below that would open the door to a much deeper correction, potentially targeting the August low around 620. Let's now drill down to a shorter time frame to see the anatomy of this sell-off. Switching to the 1-hour chart and zooming in on the last few trading days, the damage becomes even clearer. You can see the market was trading in a tight range near the highs on October 9th, lulling traders into a sense of complacency. Then on Friday the 10th, the selling began and was relentless throughout the day. There was no significant bounce, just a series of lower highs and lower lows on the hourly candles. The volume on these down moves was substantial, confirming that this was institutional selling, not just retail panic. This kind of price action suggests that the path of least resistance, for now, is to the downside. Any bounce is likely to be met with selling pressure, especially as we approach the 660 to 662 area, which was the support level before the breakdown. Now, let's look at the 15-minute chart from Friday to pinpoint exactly when the panic set in. As the news reports indicated, the Nasdaq plunged in the afternoon, and we can see that reflected here in the SPY. Notice this candle at 14:56 Universal Time Coordinated. The price fell from an open of 672.87 to a close of 667.39 in just 15 minutes on a massive spike in volume. This was the moment the tariff news truly hit the market and triggered a wave of sell orders. Following that initial plunge, the market attempted to stabilize but continued to bleed lower into the close. The final hours showed a weak attempt at a rally that ultimately failed, with the price closing very near the low of the day. This kind of intraday action is bearish, as it shows sellers were in control right until the very end of the session. Returning to our daily chart, let's put it all together and discuss the potential scenarios from here. The long-term bullish trend is now under serious threat. The market is at a critical inflection point, heavily dependent on geopolitical headlines. So, what are the reasons to be bullish? The bullish case rests on a rapid de-escalation of trade tensions. If Trump's softer tone continues or if constructive talks with China are announced, we could see a V-shaped recovery similar to what we've seen after other geopolitical scares. The underlying fundamentals of likely Fed rate cuts and strong corporate earnings in some sectors could then reassert themselves. A move back above 662 would be the first sign of strength, and a break of the 674 all-time high would signal a full resumption of the bull market. I would place the probability of this happening in the short term at around 40%, as the technical damage is significant. Now for the bearish case, which seems more probable in the immediate future. If the tariff threats escalate or if China retaliates, fear will likely take over completely. In this scenario, Friday's low at 652 will be a key line in the sand. A sustained break below this level would confirm the bears are in control and would likely lead to a test of the 640 to 645 support zone. If that zone fails, a much larger correction towards 620 is very much on the table. Given the severity of Friday's move and the uncertainty, I'd put the probability of testing the 640 to 645 zone at about 60%. It's also possible we enter a volatile consolidation phase, chopping between 652 and 662 as the market awaits more clarity. So let's recap the key takeaways. Your primary resistance levels to watch are 662 and the all-time high at 674. Your key support levels are 652, the zone from 640 to 645, and then the major support at 620. The main catalyst to watch for is any and all news related to U.S.-China trade and tariffs. Also, keep an eye on the upcoming Federal Reserve meeting at the end of October, as their decision on interest rates will be crucial. Please remember, this analysis is for educational purposes and is not financial advice. The market is extremely volatile, and you should always do your own research and risk management before making any trading or investment decisions. Thank you for watching Explain the Charts. If you found this breakdown helpful, please hit the like button, subscribe, and turn on notifications so you don't miss our next update.